Good afternoon, distinguished members of the press, ladies and gentlemen. The Monetary Policy Committee, MPC, held its 271st meeting, the first in 2020, on the 23rd and 24th of January 2020. So Happy New Year. The meeting held in an environment of sluggish global economic recovery and financial market vulnerabilities and tepid domestic growth. The committee appraised these developments and the outlook for the first quarter of 2020, as well as the rest of the year. All 11 members of the committee were in attendance. The global development. The headwinds that characterized the global economy in 2019 showed signs of moderation, giving way to improved prospects for economic recovery in 2020. Consequently, global output is projected to grow by 3.3% in 2020 from 2.9% in 2019. The downside risks to the global outlook include the broad slowdown in the advanced economies, resurgence of financial stress in the emerging markets and developing economies, rising geopolitical tensions in the Middle East, and extreme weather conditions in some regions. Output growth across major advanced economies remains fragile due to weak recovery in manufacturing activities and sluggish rise in global trade. Consequently, growth in the advanced economies is projected to slow to 1.6% in 2020 from 1.7% in 2019. With most emerging markets and developing economies facing brighter prospects, output growth is expected to recover to 4.4% in 2020 from 3.7% in 2019. The major impetus for this recovery is expected to come from India, Brazil, and Russia. In most advanced economies, inflation remained below their long-run targets, reflecting weak aggregate demand in the euro area and Japan, as well as moderating wage growth in the US, despite the robust job performance. Central banks in the advanced economies are thus expected to continue with monetary accommodation into the medium term. In the EMDEs, however, inflation prospects remain mixed, with some economies facing stronger upside risks than others. The domestic development. Real GDP continued to improve, although slowly. It grew to 2.28% in the third quarter of 2019, compared to 2.12% and 1.81% in the preceding and corresponding quarters of 2018 respectively. The improvement in growth was driven largely by the performance of the oil sector, which grew by 6.49%, while the non-oil sector grew by 1.85%. Staff projections estimate real GDP during the fourth quarter of 2019 and the first quarter of 2020 at 2.2 and 2.35% respectively. The manufacturing and non-manufacturing purchasing managers indices grew further in December 2019 for the 33rd and 32nd consecutive months to 60.8 and 62.1 index points respectively. The optimism in growth prospects during the first quarter of 2020 and the rest of the year is anchored on the enhanced flow of credit to the private sector to improve manufacturing activities and financial and exchange rate stability. In addition, the bank's continued intervention in agriculture and small and medium-scale enterprises is expected to boost growth. Identified headwinds to growth, however, include uncertainties in the oil market, high unemployment, rising public debt, and security challenges across the country. Committee noted the continued uptick in headline inflation year on year in December 2019 to 11.98% from 11.85% during the previous month. The increase in inflation, which was anticipated, was largely attributable to increase in both the food and core components by 14.67 and 9.33% in December 2019 from 14.48 and 8.99% in November respectively. The increase in the food component reflects largely seasonality effect and the impact of the continued insurgency in some food producing areas of the country. Although staff forecasts suggest a short-term upward trend in price levels, the committee believes that the bank's continued intervention in the real sector is expected to increase domestic production and lower prices in the medium term. The committee observed that broad money supply M3 grew by 6.22% year to date in December 2019. Aggregate credit net similarly grew to 27.33% in December 2019 from 23.12% during the previous month. This was largely attributed to an increase in credit to the government, which grew by 92.95% in December 2019 from 72.36% during the previous month. However, credit to the private sector also grew to 13.61% in December 2019 from 12.282% during the previous month. Consequently, sectoral distribution of credit between the end of May 2019 and the end of December 2019 were as follows. Manufacturing sector, 446.44 billion naira. General retail and consumer loans, 419.02 billion naira. General commerce, 248.48 billion naira. Agriculture, forestry and fishing, 160.94 billion naira. Information and communication, 156.47 billion naira. Finance and insurance, 129.87 billion naira. Construction, 86.54 billion naira. And transportation and storage, 68.61 billion naira, among others. Committee observed with delight that over the last 6 months, aggregate credit created by the private sector grew by 2 trillion naira and urged the management of the bank to sustain the current momentum of improved flow of credit to the private sector while exploring other options with the fiscal authorities to strengthen the legal framework for enforcement of credit recovery. Lower money market interest rates in the review period reflect the liquidity overhang in the banking system resulting from the restriction of individuals and non-bank corporates in the domestic economy from participating in the OMO bills auction. Consequently, the monthly weighted average interbank call and open buyback OBB rates fell sharply to 3.82 and 3.24% in December 2019 from 11.42 and 10.73% respectively during the previous month. The committee noted the improved performance in the equities market as the all-share index and market capitalization grew by 11.61 and 18.27% respectively between the end of October 2019 and the 10th of January 2020. This was indicative of the shift by domestic investors from the money market to the equities market in response to the bank's policy to restrict their investments in the OMO bills auction. The MPC also noted the improved performance and sustained resilience of the banking system, evidenced by the continued moderation of the non-performing loans ratio from 6.6% in October and 6.1% in December 2019. The committee noted that the improvement reflected the bank's continued deployment of heterodox policies to ensure that NPLs fell below the prudential benchmark of 5%. Outlook. Although global output is projected to expand moderately in 2020, compared with the previous year, the overall medium-term outlook for the global economy remains uncertain due to the persistence of several headwinds. These include the lingering trade tensions between the US and its major trading partners, rising levels of both corporate and public debt, likelihood of continued geopolitical tensions in the Middle East, fragile recovery of the manufacturing activities, and the narrowing policy space by which central banks in the advanced economies can respond to future macroeconomic shocks. In addition, predicted weather-related disasters could pose further threats to global output recovery. On the domestic side, available data on key macroeconomic variables show prospects of improved output growth for the economy in 2020. Revised projections for 2020 show that the economy is expected to grow by 2.5% by the IMF, 2.1% by the World Bank, and 2.35% by the CBN. The underlying projection is anchored on the following conditions: enhanced flow of credit to the real sector of the economy, sustained stability in the exchange rate, continued CBN interventions in agriculture and non-agricultural small and medium enterprises, and the effective implementation of the economic recovery and growth plan. The downside risks to this projection are primarily the rising stock of public debt and lack of fiscal buffers. Others include the persistent security threat in major food-producing areas, poor and inadequate infrastructure, and weak public and private sector investments. Committee's consideration. The committee noted the persistent increase in the inflation rate in December 2019, and that the rate is still above the upper band of 6 to 9% range or threshold. Tightening may be necessary to tame the rising trend in inflation. In addition, the relatively bearish outlook of the equities market indices points to waning investor confidence in the equities in preference for coupon rate on bonds. Raising the policy rate will be a policy choice to reverse the tendency and attract more foreign portfolio investments. Also, the risk to the level of reserves persist as prices of oil futures remain uncertain. Policy tightening would enhance the accretion to foreign reserves and attain relative stability in the foreign exchange market. Moreover, raising rates would reinforce the stability of the foreign exchange market, as an upswing in the rate will inhibit demand pressures in the market through a decline in money supply. Although tightening would limit the ability of deposit money banks to create money, ultimately leading to a reduction in money supply and curtail their credit creation capabilities, which would eventually lead to a rising cost of credit and credit risk as DMBs reprice their risk assets. The MPC believes that the aggressive pursuit of the current loan-to-deposit ratio policy thrust would continue to help to catalyze credit growth and positively impact output growth and ultimately prices. On the decision to loosen, members note that the relative stability in the foreign exchange market provides confidence to foreign investors. There is therefore no immediate concern that loosening would exert pressures on the foreign exchange market in the near term. In addition, an accommodating monetary policy stance would motivate banks to lend to maintain their profit performance and will result in decline of the overall cost of production. This will further affirm the bank's support for stimulating output growth. The committee also feels that the downsides to loosening is that it could amplify inflationary pressures as the economy experiences increased liquidity surfeit, particularly if loosening drives growth in consumer credit without corresponding adjustments in output, thus escalating inflationary pressures. An interest rate reduction would increase money supply and exert pressure on the exchange rate. Moreover, an accommodating monetary policy stance may not necessarily lower the retail lending rates, as interest rates are generally sticky downward. On the argument for a hold, MPC acknowledged that a mix of heterodox monetary and financial policy measures have recently been deployed by the bank, noting the existence of a lag between the policy pronouncements and its impact on the economy. A hold in the rate will ensure its efficient impact on the economy. Committee noted the slow pace and low rate of economic growth, as real GDP growth of 2.12, 2.38% during the first, second, and third quarters of 2019 respectively, being below the population growth rate, still needs sustained policy support and push. Maintaining monetary policy rate at its present level is essential for sustainable support to growth before any possible adjustment. This would enable policy to react suitably to developments as they occur in the near term. In addition, retaining the current policy position provides avenues to evaluating the impact of the heterodox monetary and financial policies to support lending by the banking industry without altering policy rate. On the downsides to holding, committee noted that it will reduce the speed of economic recovery relative to loosening, exert a drag on output growth as deposit money banks continue to utilize bond sales instead of engaging in financial intermediation to the private sector. In view of the foregoing, committee, by a decision of 9 members, voted to alter cash reserve requirement CRR by 500 basis points from 22.5 to 27.5%, while leaving all other policy parameters constant. In summary, MPC voted to 1. Change the CRR from 22.5 to 27.5%, retain the MPR at 13%, retain the asymmetric corridor of plus 200 and minus 500 basis points around the MPR, and lastly, retain the liquidity ratio at 30%. I thank you for your attention. Well, that we're using CRR to mop up liquidity and in order to control inflation, and that whether that will not impede lending. You will all recall that in January 2017, inflation peaked at 18.7%, and the monetary policy, realizing that price and monetary stability remains its core mandate, certainly could not sit idle and allow inflation to continue to rise, particularly above 12% inflation rate, where we think it is growth retarding. So monetary policy took those decisions to be very aggressive through tightening and using all forms of monetary policy instruments available to the bank to drive down inflation. Luckily, we were able to do this from 18.72% in January 2017 to about 11%. For some period, inflation remains somewhat sticky downwards at 11%. But suddenly, from around August last year, we began to see uptick in inflation again, ticking up to about 11.98%, which is the rate that we saw it in December 2019. In reviewing inflation, Monetary Policy Committee felt that because inflation was already getting to the level that it considers a threshold beyond which it becomes growth retarding, Monetary Policy felt compelled that we need to begin to look at what can be done to reverse the trend of this rising level of inflation and prices. And hence, the committee felt in its wisdom that realizing that there is a lot of liquidity in the market, particularly also coming from not only the fiscal that is also spending to fund its budget, but also the fact that some actors have been excluded from the OMO, and also insisting that OMOs, particularly for the local individuals and corporates, will not be allowed any longer. Committee felt that there would be a lot of liquidity in the market and there was a need for the bank to do something to mop the excess liquidity to a level that it considers optimal to be able to run the economy in a way that the level of excess liquidity does not become injurious to the economy. That is the reason committee felt, look, let's adopt the blunt process of taking this liquidity out by increasing the CRR from 22.5% to 27.5%. However, committee also said, listen, we must remain committed and focused on the fact that deposit money banks must be compelled, like we are using prudentials, to ensure that they continue to grant loans to the private sector of the economy. You'd have all observed that as a result of the policy of loan deposit ratio, we have seen loans grow from 15.5 trillion in May, or end of May, we might have said June 2019, to 17.6 trillion in December 2019. That is a 2 trillion naira growth, and in the course of reading the communique, I made it very clear the various sectors, manufacturing, agriculture, retail, all sectors that have benefited from this initiative. And committee felt that, yes, whereas we are trying to remove the excess liquidity from the market so as to operate within an optimal level of liquidity that is needed for the economy, that the CBN should continue to push on the loan deposit ratio, since that was already giving us the kind of results that we expect. So it's like, let's keep doing what we're doing, but do not remove your eyes from the ball regarding the excess liquidity and what needed to be done to take this liquidity out so this economy can run in an optimal way that does not create inflationary pressures and by extension exchange pressures on the economy. So that is it. So committee has looked at your issues and insists and believes that it will not constrain lending the way we've already started seeing lending grow in the economy. The third one also talked about, he said that analysts are noticing declining reserves and the rest of them, and that whether this will not put pressure into an adjustment in exchange rate or devaluation, as you put it. It's important for us to know that reserve is there to meet obligation, right? The country's obligation. So from time to time, reserves will go up, reserves will come down. Yes, it is no doubt noticeable. The drop has become so noticeable that people are beginning to say, oh, will they result in an adjustment in the currency? At a reserve level of about 38 today, right? And crude price at above 57, 60, 65, sometimes hit 70, we believe that we will be able, and we are saying that we should continue to sustain the existing FX, foreign exchange management and stability that we've seen in the market. There is no need for anybody to ever think that an adjustment would happen. The CBN is able to meet all obligations. The reserve level is high and strong enough to be able to meet obligations in the economy. And so there's no need for anybody to contemplate that. One, We believe crude price at above 60, crude price today at almost about 66 to 67, sometimes hitting 70. It's a strong level that can be used to support the economy and also continue to sustain the stability that we see in the foreign exchange market today. Debt to revenue rising, yes. And are there data in 2019 that need to be looked at for 2020? Yeah, the MPC looked at the debt to revenue and felt that, listen, that there is always a tendency for us to say that our debt levels are not high, particularly when you begin to compare it to GDP. But that, yes, whereas that is correct, but that we need to begin to look at other ways through which we can raise revenues to be able to fund fiscal operations. And that is just what the MPC is saying. Now listen, let's not be carried away by the fact that yes, debt to GDP is low, or sometimes we say even among the lowest in the world, but let's not be carried away by that. Remain focused and begin to think of the fact that we must do something to raise revenue to be able to fund our operations. That's where we are on this subject. Lastly, call that we've been talking about consistently, the implementation of economic recovery and growth plan implementation. We all must know that the economic and recovery growth plan is like a Bible, which both the monetary, fiscal, and government came together to put together to say, look, this is the Bible that will guide the operation of government in the next few 4, 5, 6 years. So it's like saying this is our own blueprint, this is our own development plan that we're going to follow. So we should not be surprised that almost at every MPC meeting that the MPC continues to say, look, don't take your eyes off this Bible. Continue to read it and focus on continuous implementation of the contents of that Bible. That as you do so, we will get out of the problem. In any case, when you talk about what are some areas, even this community talked about infrastructure. Power is a big issue, which I'm aware and I know, and we are working together with Fiscal to ensure that we deal with the perennial problem of power. Believing and we know that if we're able to deal with power, it is going to have exponential or multiplier effect on GDP, and which is what we also very badly desire, because we want to create jobs for our people. Thank you. 1.98% in December 2019. It also noted that inflation is driven by both monetary and structural factors. Having addressed the monetary factors, the headroom for further monetary policy measures has become constrained, being supported by empirical evidence that suggests that inflation above 12% is inimical to output growth in the Nigerian economy. The Monetary Policy Committee thus called on the fiscal authorities to speedily address legacy structural impediments giving rise to upward trending price developments. Amongst this, the committee identified infrastructure deficit and the long-standing clashes between herdsmen and farmers, which are constraining domestic production and contributing substantially to a rise in food inflation. MPC therefore urged the federal government to relentlessly seek innovative ways of addressing security challenges across the country in order to boost aggregate food supply. The committee further noted the contribution of imported in food and other tradables to the rise in price levels, but emphasized the opportunity to ramp up production of domestic substitutes supported by the bank's development finance initiatives, particularly in the agriculture and manufacturing sectors. Committee noted the improvement in the financial soundness indicators, growth in assets of the banking system, and the gradual switch in the composition of deposit money banks' assets from investments in government securities to growth in credit portfolio, to the private sector. It therefore noted that lending rates at the retail segments of the market had remained fairly sticky downwards as deposit rates had declined substantially. It also noted that in some cases, deposit money banks were not encouraging term deposits in their portfolio and therefore emphasized the bank's commitment towards improvement of the loan-to-deposit ratio policy. On fiscal operations, the committee applauded the government for the recent signing of the 2020 Finance Bill, which opens a new vista of opportunities in public financial management. The MPC, however, cautioned that public debt was rising faster than both domestic and external revenue, noting the need to tread cautiously in interpreting the debt-to-GDP ratio. Committee also noted the rising burden of debt services and urged the fiscal authorities to strongly consider building buffers by not sharing all proceeds from the Federation account at the monthly FAC meetings to avert a macroeconomic downturn in the event of an oil price shock. It urged government to gradually reduce reliance on oil receipts and focus on revenue diversification through reforms of the tax system. Committee also called on government to rationalize fiscal expenditure towards reducing the current excessively high cost of governance. MPC expressed concern about the rising inflation, which increased consecutively in the last 4 months as at December 2019 to 11.98% and higher than its target range of 6.9%. This rising price level is attributable to a combination of structural and supply-side factors, expansionary fiscal policy, and growth in money supply arising from rising liquidity surfeit in the industry due to changes in the bank's OMO policy. In furtherance of its primary mandate to maintain price and monetary stability, and in view of the anticipated medium-term liquidity surfeit from maturing OMO bills held by the local private and institutional investors, which would not be rolled over, committee considered it prudent to raise the CRR to curtail liquidity surfeit in the banking system. Committee is confident that increasing the CRR at this time is fortuitous, as it will help address monetary-induced inflation whilst retaining the benefits from the bank's loan-to-deposit ratio policy, which has been successful in significantly increasing credit to private sector, as well as pursuing market interest rates downwards. The committee further encouraged the management of the bank to be more vigorous in its drive to improve access to credit through its pursuit of the loan-to-deposit ratio policy, as doing this would help not only in creating job opportunities, but also help in boosting output growth and in moderating prices. It is noteworthy that gross credit in the industry grew by 2 trillion naira between May 2019 and December 2019, channeled primarily to the employment-stimulating sectors such as agriculture and manufacturing. In addition to increased lending to the retail and SME segments, which is expected to help boost domestic output growth in the short to medium term. To retain the gains from the credit expansion and current industry focus on lending, committee advised the bank to sustain its loan-to-deposit ratio policy and, in addition, continue to deploy its DCRR policy, which directs new funding for greenfield projects and expansion to the critical sectors of the economy, particularly to the agriculture and the manufacturing sectors. Committee's decision. On the arguments to tighten